Right. So, we were talking about the issue of relationship between delta S and delta V. Now, the important thing here is that when we work out when we plot a graph between delta V and delta S, we do not get a straight line. That means that the delta V that is resulting or is arising when there is an unanticipated change in the exchange rate has a component which is directly related to delta S, and another component which is more of a random in nature, random in the sense that it encodes information about other factors which are either not identified or identifiable, or their impact on delta V not quantifiable. You see, sometimes it does happen that the cost of obtaining additional information outweighs the benefit that is derived from it. So, once we find that this particular delta V here is aligned with delta S, and there is some random there are some other factors which are also coming into play, which are also contributing to delta V in some manner, but we do not have access to the information on those factors. We do the next best thing, we model them as a random variable, and that is more or less a standard practice, and this process is called regression. So, by virtue of this process, we segregate delta V into two parts, one component that varies in tandem with delta S, and the other component which is of a random character. I reiterate, it may not actually be entirely random, it may not actually be entirely uncertain, but because we have insufficient knowledge either about the factors contributing to it or the manner in which those factors are contributing, therefore, we model them as random variables. Of course, if we collect more and more information and use statistical techniques like principal component analysis, we can come out with some more factors which, in addition to delta S, would probably do a better job in explaining the variance of delta V. This is called principal component analysis, but by and large most of the finance theory is built around a single factor model, which we are observing here, where delta V is taken as having a direct, this is called a systematic relationship. When you have some kind of a predictable relationship between two variables, it is called a systematic relationship. So, here delta V is having a systematic relationship with delta S, and we model the rest as a group and call them random. So, we can write this as delta V is equal to beta delta S plus some random component, let us call it A I. Of course, I will put subscripts A I, because A I refers to the observations that we are talking about, 1, 2, 3, 4 and so on, number of observations. Then we make a little bit more of simplification. We write A I as alpha I. We are splitting this up this random thing as the mean value, which is alpha, and the deviations about the mean value, which we say are E I, small e I. Obviously, the deviations about the mean value sum to 0. That is what we are simply trying to say. One more condition that we impose is, we assume that the factor that we are talking about and the other part that is random are independent of each other. They are not correlated. Let us see what are the implications of this. And this equation, this particular equation that we have at the end of the day, Let us write it again. Delta V I or delta V is equal to beta delta S plus alpha plus E I. This is called the regression equation. This E I represents the randomness about the mean value, and this represents in some sense the equation of this line. Some sense, that sense we will talk about in the next slide. I have already mentioned what a systematic relationship is. A systematic relationship between two variables exists when there is some predictable manner in which these two variables move on the average or over a period of time, over a set of observations. Now, look at this diagram. This forms the substratum of regression that we have talked about just now. I have used general notation. Y in our case will represent delta V. Beta 1 and beta 2 are respectively alpha. Alpha is the y intercept and beta is the slope of the regression line, and we call them, for convenience of notation, we call them beta 1 and beta 2. This is the matrix representation of the equation that we wrote in the previous slide. Delta V is equal to beta delta x plus alpha plus E I. These E I are the random terms or the error terms, which the deviations from the mean of the error terms or the random terms. In terms of matrices, we can write this as y is equal to x beta plus E, where E is the error term which is extracted after taking into account the mean value, which is alpha. Now, how do we run the regression? Well, we run the regression by identifying that particular straight line. Let us go back for a second. We identify that particular straight line. This line f g has that specific character that the squares of the deviations from this, that is these distances, squares of these is a minimum. That is why it is called ordinary least squares regression. So, in terms of matrix notation, we can write it as E transpose E, which is nothing but the squares of the deviations from the mean of the error terms or the random terms. And on simplifying this and using this matrix operations on the transposes, we arrive at this expression. Differentiating this, now differentiating what? Differentiating this, and this is nothing but this. So, differentiating this with respect to these two terms, beta 1 and beta 2, which is nothing but alpha and beta in our case. Differentiating S, that is the square of the error terms, square of the deviations with respect to alpha and beta, we get this equation, which is called the normal equation. This is the normal equation. Now, as you can see, there are some important observations. As you can see from this is equal to 0, and what is this? X transpose, that is this transpose into the error term. This shows that these two terms are orthogonal as we wanted. Orthogonal means the covariance must be 0. That is, the delta S term, in our case the delta S term and the error term do not have any covariance, do not vary in tandem. That is what. Now, this has been obtained through regression. So, what is the implication? The implication is that the very process of regression, the very process of fitting the regression line automatically implies, if you fit the regression line using the ordinary least squares method, you automatically imply that the error term and the factor, the regressor, are orthogonal to each other. In other words, there is no projection of the regressor on the error and vice versa. There is also another implication, and that is this one. This also we said that the deviations about the mean, deviations from alpha of the error terms must sum to 0. That is to be expected, because the error term has been extracted as the random component from the mean. Alpha is the mean, a was the original random component. Out of this we extracted out the mean, what remains is the alpha. So, the randomness is captured by the error term E, and the sum of these error terms about the mean must be 0. This is a note on the differentiation, because some of the viewers may not be acquainted with matrix differentiation. So, I thought I would put a slide here on the matrix differentiation. This is how the differentiation of matrices is done. For those who find it difficult to understand the summation notation, I have put an example as well. This example is of a 4 by 4 matrix, and this 4 by 4 matrix has been differentiated with respect to 4 variables beta 1, beta 2, beta 3, beta 4, and the result that has been obtained in the previous slide has been obtained in the case of this example, just as a illustration of the process. So, before we proceed further, just a brief recap. In this particular situation, we are investigating the change in the value of a foreign asset designated in home currency, the change in value of a foreign asset designated in home currency due to an unanticipated change in the exchange rate, and we find that in addition to the exchange rate, other factors are there which influence the value, and therefore, because we have incomplete information about these other factors, we prefer to use them as we prefer to model them as a random variable, and incorporating that in our analysis, we run a regression. When we run a regression and fit the regression line by using the principle of least squares or ordinary least squares, we implicitly assume, or we implicitly infer, or we implicitly incorporate into the analysis that delta s, that is our independent variable, and the random term are not correlated, and number 2, the error term has a summation of 0, which is about the mean position. These are inbuilt into the regression mechanism. Now, let us come back to finance. We are going to talk about hedging. Hedging relates to risk relates to exposure. We have talked about how delta V changes with respect to delta S, but there is a component beta, the slope of the regression line inbuilt in it, plus of course, we have some alpha. This is the regression line. When we fit the regression line, we take this works on the average, and because this works on the average, the E term vanishes, because the expectation of the E term is 0. Therefore, that term in the regression line, that E term will not appear. Anyway, so this beta, what is this beta? This beta is the sensitivity of delta V to delta S, the sensitivity of delta V to delta S. How does delta V represent or respond to delta S? If delta S changes, how is the reaction outcome of delta V? This also shows a systematic relationship between delta S and delta V. In other words, given some change in delta S, we can predict delta V on the average, because this is a statistical relationship. It will not, you see, it is not a deterministic equation. So, it will not hold in each and every case. In each and every case, you will not get it. If it was so, you would have got a straight line fit all the time, you do not get it, but on the average this will hold. In other words, if you run the least squares regression, this is what you will get. So, this beta which represents the sensitivity of our dependent variable, of our value of the worth of our asset to delta S, which is our risk stimulus, then this beta is called the exposure. Exposure is a measure of how our worth, our asset is reacting to the risk stimulus. Exposure is therefore a sensitivity. It is a sensitivity of delta V with respect to any independent variable, any risk factor, risk variable, that is delta S. Now, a very important point, I have been talking again and again unanticipated change in exchange rate. Why unanticipated? The point is, if any change in exchange rate is anticipated, that means the market anticipates it and the market knows about it. If the market knows about it, it incorporates it in the price, and therefore, when the change actually occurs, it is not supposed to influence the price, provided of course market efficiency is guaranteed, because that change in exchange rate was already known. So, if it is going to happen, it is a known phenomenon. So, the change in value corresponding to an anticipated change in exchange rate is already a known phenomenon, and therefore, built into the price at which that asset is traded in the market at t equal to 0. Now we come to risk. So, having talked about exposure as the sensitivity of the dependent variable, that is our asset, the value of our asset, sensitivity of the value of our asset to some factor by which it is influenced, to some factor by which the value is influenced. Now, there can be two approaches to risk. This gives rise to two approaches to risk. As we know, risk is measured by variability. If there is no variation, there is no risk. I will come back to it. If there is no variation, there is no risk. So, risk has something to do with variability. So, variability, when we talk about variability, we can talk about the variability of delta S, or we can talk about the variability of delta V, which is equal to beta delta S. We can talk about the variation of this, or we can talk about the variation of this. If we talk about the variation of delta V, beta automatically comes into the picture. In other words, if beta is 0, then if we measure risk by the variation of delta V, then there is no risk. In other words, if there is no exposure, there is no risk, provided we use the second definition, that is the first definition here, provided we use this definition, then risk arises only if we have exposure, because beta comes into the picture. So, one way is you measure simply the variation of delta V, and the other is that you the first is you measure simply the variation of delta S, I am sorry, measure simply the variation of delta S, the independent variable. The other is that you measure the variation of delta V, but delta V being a product of beta and delta S. Therefore, beta also comes into the picture. In other words, and what is beta? Beta is the exposure. Therefore, if you have exposure, you have risk. If you do not have exposure, you do not have risk, provided you use delta V as the variation of delta V as the measure of risk. Conventionally, it is the practice to use the variation of delta V, the variation of delta V, the changes in the value of the asset liability, which is influenced by the risk factor, as a measure of risk. That is the common practice. Now, we come to the very important question. All of us are familiar that standard deviation constitutes one of the most common, probably the most common measure of risk. There are other measures of risk. Value at risk is gaining ground on a regular basis. In fact, as The margins that are computed in our stock and futures markets are based on value at risk, not on standard deviation. Of course, standard deviation is an input to the value at risk computation, but of itself it does not determine the margins. Margins are determined by value at risk. There are other measures as well: conditional shortfall, expected shortfall, conditional value at risk. So, there is cash value at risk is another one. So, there are a number of measures of risk, but standard deviation continues to be the cardinal measure of risk, or at least the most popular measure of risk. Whether it is the most appropriate or not is questionable, but it is certainly the most popular. There are reasons behind this. The first thing that we must understand is that risk relates to fluctuations, risk relates to variability, risk relates to vibrations. If there is no fluctuation in price due to a factor, that does not constitute risk. For example, if you look at treasury bills or if you look at fixed deposit, they are said to be less risky or very limited risk. Why? Because the prices do not change much. The prices, the change in prices of treasury bills are only the change in the time value of money, only due to the change in time value of money. Due to the holding of the treasury bill, they may undergo changes in prices, but the yield itself is normally does not change on a very regular basis. Certainly, it does not change 100 or 200 times in a day like the prices of stocks. And stocks are definitely termed to be more risky than fixed income securities. Why is that? How do we define risk? Risk is the possibility or the chance of not meeting a targeted outcome. You have a targeted outcome, you want a targeted outcome, you want to achieve a certain target. The probability or the chance of not meeting that target contributes to your risk. For example, if you want a certain return on your portfolio of say 18% per annum, the fact or the possibility that you will not achieve that 18% per annum contributes to your risk. So, it is very clear that greater is the fluctuation of the return, greater is the chance that you may undershoot or overshoot that particular target. If there is no fluctuation, then you are literally assured of meeting the target, because the target would have been set on the basis of that particular assured return. So, there is little chance of missing the target. But if there is fluctuation on a daily, on a hourly or a minutely basis, then there is a significant possibility of either overshooting or undershooting the target. The chance of that undershooting the target constitutes the risk that you face. Now, that being a risk, it is an immediate corollary that risk relates to variability, and one of the most common measures of variability is standard deviation. The immediate reaction would be, sir, we are not concerned with the upside part of the fluctuation, we are more worried about the downside part. But then standard deviation gives equal weightage to upside and downside fluctuations, and more importantly, empirical studies more or less, not exactly, but more or less vindicate that the prices of financial assets are symmetric in their movements about the mean. So, if you measure the fluctuations on the up or on the downside of the mean position, it really makes little difference because of the symmetry embedded in them. Now, this is not exact, but this is more, it is pretty close. There is another very important issue. Sometimes we are willing to sacrifice certain things for the cosmetics of it. Now, standard deviation coupled with expected return gives a comprehensive and an excellent theory of portfolio optimization of Harold Markowitz mean variance optimization, and it provides coherence. to various approaches to portfolio optimization. It gels well with the issues relating to microeconomics. So, these are things which contribute to its popularity. I reiterate, whether it is correct or not, whether it is precise or not, I am not addressing that question. I am addressing the question of its popularity. It is being used, it has been used for years together, and it has been used more and more frequently. There is another thing. Stock prices are usually modeled at logarithmic variables, log normal distributions. That being the case, now in the case of a normal distribution, all of us know that mean and standard deviation, these two parameters only, are good enough, are adequate enough to quantify or to represent the entire distribution. And if they are good for a normal distribution, they are good enough for the log normal distribution. So, these aesthetic values, the cosmetic values of using standard deviation as a measure of risk are very significant. Nevertheless, as computing power grows, as we are now having access to more and more high frequency data, high quality computing power, other measures of risk are being explored, are being investigated, but still standard deviation continues to be popular. I was just talking about the concept of systematic and unsystematic, or the systematic and the random splitting of the change in values embedded in the regression. Let us look at one more implication. Let us look at one more implication when we use standard deviation as a measure of risk. It is very interesting. If you use standard deviation as a measure of risk, the variance of course, same thing, variance as a measure of risk, then the first step is obvious. We write delta V as alpha. Delta V is the instantaneous change in value, that is alpha plus beta delta S plus the error term, random term, minus mean value of that, because delta V is given by this. Now, look at this. The mean value of alpha is alpha, the mean value of alpha is alpha, the mean value of the error term is 0, and therefore, when you simplify this, the alpha goes, and we are left with beta delta S minus E of beta delta S, which comes from here, E of beta delta S, and this E remains. This E goes because the mean value of this E, the mean value of this E is 0. So, this goes, E of alpha being alpha goes against this, and we are left with E of beta delta S, this one, minus E of beta delta S, this one, and then we have this E term which is here, this E term goes. So, when we do the squaring and we note that beta is not stochastic, not random, because it is determined by the OLE equations, ordinary least square equations. So, beta square goes out of the expectation operator, and we are left with delta S minus E delta S. E delta S is the expectation of delta S. E represents the expectation operator. I do not know where I mentioned earlier. E represents the expectation operator, the mean value. So, beta square into E delta S minus E delta S, and this expression is nothing but the variance of delta S. This is the variance of delta S, and this E of E square, the expectation of E square can be written as E of E minus 0 square, that is equal to E minus E of E, because E of E is 0 square, and that is nothing but sigma E square. So, in other words, what we are getting here is sigma of delta V square is equal to beta square sigma delta S square, plus sigma of E square. This is the variance of the error term, this is the variance of the systematic term. This is called the systematic risk and this is called the unsystematic risk. This is the systematic risk, this is the unsystematic risk. And very interesting point here, is that there is an orthogonal partition between these two. If you look at it, it is in a nature of a Pythagoras theorem, c square is equal to a square plus b square. So, there is orthogonal partition between these two, the systematic risk and the unsystematic risk. Thank you.